Oh, okay, I just realized something about the Federal Reserve, and it's quite important. Almost nobody's talking about this. Even billionaire Bill Ackman is not realizing something that I think is up Jerome Powell's sleeve, and I think I see it. I want to share it with you and see if you see what I'm seeing, okay? But first, billionaire Bill Ackman, okay? Who thinks Sam Bankman-Fried is telling the truth. Oh, God, I didn't mean to say that. I'm sorry. Look, I respect Bill Ackman, but there's some things that I don't like, okay? I don't like it when you say you trust what Sam Bankman-Fried says. I replied to you when you said that, and I said I thought you were crazy. I also did not like that at the bottom of the market in 2020, you went out on CNBC and told everyone the entire country needed to lock down for 30 days, leading to massive capitulation and panic selling, while your out-of-the-money puts printed money 10x or more. Anyway, with that out of the way, let's go on to what billionaire Bill Ackman says here. The Federal Reserve's 2% inflation target is no longer credible. No longer credible, he says. Okay. Deglobalization, that would be disinflationary. Globalization is disinflationary. Let's get that right. Globalization is when we start using foreign workers. Globalization is deflationary, disinflationary. Prices either rising at a slower pace or coming down. Deglobalization is more home-based manufacturing, which we are seeing that. That actually raises prices, right? And we're seeing that with the CHIPS Act, battery manufacturing. Okay. The transition to alternative energy, yeah, that's actually also true. That is inflationary. The need to pay workers more, okay, that's a little political. Lower risk, shorter supply chains are all inflationary. Yeah, that's true. The Fed cannot change its target now, but will likely do so in the future. So Bill Ackman is making this argument that 2% will change in the future, but they've got to relax now with 2%. Okay. When asked, Powell recommitted to the 2% target, but admitted that examining a higher rate was a possible longer-term project. Businesses need price stability, but can thrive in a world with 3% stable inflation. I don't think the Federal Reserve can get inflation back to 2% without a deep, job-destroying recession. And if it gets back to 2%, it won't remain stable there for the long term. Accepting 3% plus or minus inflation is a better strategy for a strong economy and job growth over the long term. Okay, so it's actually not a poorly constructed argument, right? Not poorly said. So if this is the case that, look, our economy can support 3% inflation, and we do have things that create inflationary pressures. Short term, obviously, we have war, supply chain shortages, China's lockdown, which leads to manufacturing issues and shortages, worker shortages as we have a retransition of workers, more people retired after COVID. A lot of things are temporarily inflationary. Obviously, you also have massive money printing that happened, but this argument then of alternative energy and deglobalization are potentially also slightly longer term inflationary. So Bill Ackman says we should raise the inflation target from 2% to 3%, which the Fed has been hounding on 2% for a very long time. And if they change their 2% target, and in other words, relax to a 3% target, they would substantially hurt their credibility. This is very different from what we had in the late 70s and 80s, where the Federal Reserve was able to raise rates substantially and then lower rates, but they took advantage of something called opportunistic disinflation. That's a fancy way of saying they kind of just let inflation go down over sharply 1 year, but then it took like 15 years to get down to 2%. They just sort of like, oh yeah, we're on the right path, no rush, right? Well, what Bill Ackman here is suggesting implies that the Fed won't stop until they get to 2%, which is actually not true. See, the Federal Reserve told us they won't stop until they are on the trajectory towards 2%. And we need to go back to something that was announced by the Federal Reserve in 2019, and that was called FAIT. FAIT is spelled F-A-I-T, but it's pronounced FAIT, and it stands for Flexible Average Inflation Targeting. How convenient that something called FAIT would be released right before some of the greatest inflation ever since the 80s. But aside the point, FAIT basically says, hey, look, we want inflation to average 2% over the long term. We don't have to be at 2% right now. We just want it to average 2%. And as long as it averages 2%, we actually don't really need to be at 2%, depending on how long we were under 2% beforehand. And so this is quite interesting because what was inflation before the pandemic? But not only that, are we talking about CPI or are we talking about PCE? Well, don't worry. I already have the answer, and no, it is not you checking out with that coupon code expiring tonight, coupon code PP, for the amazing programs on perspective, building your wealth with real estate investing, stock investing, being a hustler, making more money at your current job, making money on a side hustle, you name it. There's some incredible programs with lifetime access to live streams on building your wealth every day the market is open. Link down below. The Federal Reserve tells us that the 2% target is actually headline PCE inflation. See here? The FOMC's target in terms of inflation is the headline PCE inflation rate. And the target FOMC has set, or what the target is that they've set, is 2%, a level that policymakers judge to be consistent with achieving price stability and maximum employment. On average, inflation was slightly below this target before the pandemic's economic shock. How convenient that the Federal Reserve is actually talking about exactly what I just said on the St. Louis Fed website. Headline inflation on average was about 1.8% in 2020. The FOMC adopted this new policy framework they started talking about in 2019 called FAIT, and that is to ensure that policy would average, or inflation would average 2% on average. So what is the PCE inflation rate? Well, it's actually a lot lower than the CPI inflation rate. In fact, if you look at what CPI is right now, CPI right now fell to 7.1%, which is phenomenal. We're happy that CPI fell to 7.1%. We could see that evidenced right here on the Bureau of Labor Statistics website. What we can now do is same place, PCE inflation rate, give that a quick little slap into Google, and the PCE inflation rate in October sat at 6%, which is almost a whole percentage point lower than CPI, right? But not only that, take a look at this. This is a chart showing you the average PCE inflation rate year over year. So it's throughout the year, what was the average in that year relative to last year. And what you can see are these various different inflation rates here. And you can see a lot of these are actually under 2%. 1.8, 1, 0.2, 1.5, 1.35, 1.86. You get the idea. So what I decided to do was export this data, put it all on a table, and then average these numbers up starting at a certain decade for PCE inflation. And the results are actually quite interesting. I'll delete this for a moment. There we go, the bottom one. Look at this. The average inflation rate for PCE since 1990 has been about 2.12. Since 2000, 2.17. Since 2010, 2.2. I'm obviously purposefully leaving out the 70s and 80s because the average will skew slightly higher, though even if you took those periods into account, not much. You could take this entire chart into account and you'll end up with something like 3 point something percent. But we've had the great moderation since then, and I don't think we really need the last 100 years to average 2%. Probably more or less it's going to be something like the 10 years before and after a certain point that the Federal Reserve will want to see inflation average 10 or 2%. So, in my opinion, the Fed's probably going to want to see something like a 2010 to 2030 average 2% inflation rate. And what would it take to achieve that? Well, what I did is I went all the way down to where we sit now, 2022. I threw in 6.1 for a year-end average here, and then I took the summary of economic projections from the Federal Reserve, 3.1, 2.5, and 2.1, and threw those in. So yellow is roughly what the Federal Reserve is estimating for inflation, or what we could expect inflation might be for the next few years, the ones again listed in yellow. The Fed does actually think 2022 median inflation will end at 5.6%. I think that's a little bit low, so I personally went with 6.1, but let's use their number just for the sake of this. And now, let's assume that inflation actually goes under 2%, and we'll play with this. Let's assume it actually goes under 2% for the rest of the decade. If that's the case, what does inflation actually look like on average? Well, we'll paste, oh, darn it, I ruined my paste formula. So we'll go ahead and do it together. Average, so that way you could see it is legit. And we're just going to go grab it from 2030. I'm going to go ahead and pull that all the way to 2010. That's 10 years basically in either direction. Look at that, 2.08, which is actually less than any of the other inflation scores. Now, obviously, it would take up a little bit if we went over here and increased this to just 2%, right? If we made each of these 2% and we just happen to stay around 2%, what does it end up looking like? It looks like 2.18, which is actually not terribly off of the other decades anyway. So in other words, the market right now, at least some individuals in the market, think there's no way we're going to get back to 2% inflation. That's insane. The Fed's going to crush us to oblivion. We're not going to invest in the market until the Fed ruins their credibility and changes the 2% inflation target. And I'm looking at it going, oh my gosh, nobody's realizing this. The Fed literally told us right before the pandemic, hey, new policy framework. We do flexible average inflation targeting around here called FAIT. Now, when Jerome Powell was specifically asked about potentially changing their inflation target above 2%, he actually responded quite frustratingly, suggesting absolutely not would there be a consideration of raising the inflation target. That's because, remember folks, Jerome Powell needs to talk inflation down, but actual written policy at the Federal Reserve says, while I talk inflation down, don't worry, our policy averages it out anyway. So we just have to be moving in that direction because then we'll get an average. We had a substantial period of lower inflation. Now we have higher inflation. And if we have lower inflation on the other side, it's okay. We don't have to rush to 2%. That's actually, in my opinion, very bullish. Now, I don't want to be misunderstood for suggesting that's it. Oh my gosh, Kevin made a revelation. That's it. It's time to go all in. No, it's actually to show you that even though markets could be pessimistic and sit on sidelines waiting for the Fed to say, that's it, we're changing our inflation target, which I don't think they will do because they'll shoot their credibility in the foot, whatever's left of it. The Fed may soon, once inflation actually consistently shows it's on a downtrend, reiterate, hey, y'all, remember how we have a policy of FAIT? Yeah, so we're actually going to drop interest rates now because we think we're substantially on the way to lower inflation. And, you know, since we're going to average it out anyway, we don't necessarily have to rush it, and we want to support the economy a little bit more. Historically, the best time to invest is when the Federal Reserve not pivots, which is reducing the rate of increases or pausing, but rather when the Federal Reserve actually starts cutting. We'll see. It's an interesting revelation. Let me know what you think in the comments down below and check out PP.